Joining us now with some investment strategies is Stephane Monier. He is the Chief Investment Officer at Lombard Odier. Thank you very much indeed for coming in. You're not overly optimistic then?
No, that's right. I think we are in a situation where the outcome will be very bimodal in terms of, I would say, future of the Eurozone. And the probability of having the zone to break in the next 3 years seems pretty high to me, because there is no political institution really to resolve the crisis.
The situation, if Spain gets aid, that is a big leap forward in terms of this crisis and its developments. Spain is a country that, in terms of scale, dwarfs the previous 3 countries that have been put into aid packages in aggregate. It's a big step, and Italy's got to be the next one in line.
Okay. Well, it's a big step, but we have had a lot of promises already regarding big steps, to solve the crisis. And every time we go through the details of the plans that are put in place by the authorities, then we realize that they are probably not enough. So, we need more details about this big step that will be made for Spain. I'm
not saying it's a good big step. I'm just saying it's a big step.
Yeah.
How do I position for this? What is the investment case? Am I preserving my money at the moment? And if so, how do I preserve my money?
I think the most important element is to preserve your money and try to invest into safe assets. And the difficulty is to define in today's world what is safe, because maybe even bond yield being as low as they are not that safe if rates were to go up. So what we have done for our investors at Lombard Odier is try to develop a methodology to invest into the soundest issuers based on their ability to repay and not on how much debt they had outstanding, which is the usual way the asset management industry works.
So, okay, that's one criteria you're using. Just sort of, what is the investment thesis at the moment? How are you making those judgments? It's the ability to repay, but that seems like a fairly straightforward way of approaching it. What else are you using?
Well, it's mainly detailing what is the ability to repay. So we take into account macroeconomic factors, so things like debt to GDP ratio, but we also take into account some social and demographic factors. So, for example, for a country, we take into account political risk, and we measure it with an index that we call the misery index, which is the sum of the inflation rate and the unemployment rate. We do believe that the level of unemployment creates social tension that leads to change in government. So, for example, we expect in the European landscape to have a lot more extremist form of political party coming to power, which will break, I would say, the coalition in favor of the euro, and will make those countries much more difficult to govern going forward. And that's why we are quite cautious, generally speaking, about the
In a breakup, is the Bund a safe place to be? You're going to get paid back in potentially something that is denominated at a far higher level, but in the meantime, Germany may have to bear significantly higher costs.
Yeah, I think it's the Bund is a good investment in the scenario of the breakup in the short run, but probably not such a good one in the long run.
And what other assets would you be choosing? Just sort of walk me through. If I'm sitting there and I am worried about what I'm seeing on the headlines in front of me, just give me the safest places to hide.
Well, the safest place to hide is probably outside of the Eurozone, and we would recommend high-quality sovereign outside the Eurozone, such as Australia, Canada, some countries in Asia as well.
Corporate credit?
Corporate credit, I think, is we favor corporate credit over sovereign in the current environment. However, we will, for the short term, be cautious, because in a crisis, as we expect to develop in the coming weeks, there will be risk aversion and they won't do so well. However, for the medium to long term, I would say, I would recommend to invest into what we call the 5B segment, which is the crossover segment, which is issuers rated BBB and BB, because they still offer reasonable yield, and the structure of their balance sheet is strong enough not to be bankrupt at a time where there is a strong recession.